Good morning, students. Welcome to the session. Yes, today is Sunday early morning session on the direct taxes. Have you revised the demergers, amalgamation? Yeah. Yes or no, students? Fast. What did we discuss in the last class? Let me just quickly recap. So, basically, we were discussing the reorganization. So, all of you with me now, I want you to be with me and tell me what did we revise? Yes, very quickly so that we are all on the same page. Very good, Sailesh. Good morning. Yes. So what was amalgamation? What is the definition of amalgamation? Yes. And 21B, section 21B defines amalgamation. Yes. Okay, quickly tell me, whosoever knows. Faster. Let me just have a quick recap and let's see like what you remember. Yes, good morning, Viraj. Yeah. So, what did we study? Yes, faster. Yes, students. So, amalgamation was defined as the when the all the assets and liabilities are transferred, all the assets are transferred, liabilities are transferred, and all the shareholders which are there of the amalgamating company. Sorry, the three-fourth in the number of of the shareholders should become the shareholders in the amalgamated company. So at least 75% of the shareholders should become the shareholders in the amalgamated company. So if these conditions are satisfied, only in that situation you will have the amalgamation and the 2-1 be satisfied. Now, what if the amalgamation conditions are satisfied? What will happen? Yes. What will happen? Yes, students, faster. I'm not getting any answers. Good morning, get up, everybody. Yeah. So in that case, 47 says whether when there is a transfer of a capital asset, that will not be considered as a transfer. Secondly, what does it try to say is that the in the hands of the shareholder also, it will not be taxable under 47(7). So in the hands of the company under 47 6 and in the hands of the shareholder under 47(7), it will not be taxable. And finally, what does it say? 56(2)(10) also will not become applicable. Correct? So that is about the amalgamation. Then secondly, what does it say is in respect of the amalgamation, the uh, assets which are getting transferred. What will be the cost of that asset if it's a depreciable asset versus whether it's a non-depreciable asset? So in both the cases for the depreciable asset, it will be a WDV in case the block is getting transferred. In case of a non-depreciable asset, then in that particular case, it will be the cost to the previous owner. Of course, we will do the clubbing of the period of holding as well as we will consider the indexation from the previous owner where the asset was first held. So Manjula Shah judgment applicable. Correct? Also then what did we discuss is that in case the shareholder receives a consideration in cash, that will be taxable. For a shareholder, if the shareholder gets the shares in the amalgamated company, what will be the cost of those shares? It will be the cost of the shares in the amalgamating company. Now, period of holding and indexation here will also be clubbed. So, Manjula Shah applicable. Right. Then we saw that in case of the depreciation, you get the proportionate amount. Now, with respect to the losses can be carried forward by the amalgamated company for a fresh period of 8 years, unabsorbed depreciation for indefinite time. In case you violate these conditions, then the UAD and the brought forward losses will be deemed to be the income of the amalgamated company. What are the conditions? That the amalgamating company engaged in business for more than 3 years has held 75% of assets for 2 years. For amalgamated company, again holds 75% of assets for 5 years and continues the same business for 5 years. Then what was demerger? Demerger was defined under 219AA. Demerger was defined under, yes, good morning, Geeta. Demerger was defined under 219AA, where all the assets, all the liabilities are transferred at the book value. Then the resulting company should issue the shares to the shareholders, and the shareholders not less than 75% become the shareholders in the resulting company. And the transfer is on a going concern basis and is for a genuine business purpose. Then if these conditions are satisfied, again, the transfer of a capital asset from the merged company to a resulting company will not be transferred under 47(6)(b). It will not be transferred for the shareholders under 47(6)(d), and 56(2)(10) will also not be applicable in the hands of the company. Now, what will be the cost of the capital asset? The cost of the capital asset shall be the book value in case it's a non-depreciable asset. If 49(1) does not talk about that, but 219AA that says that the transfer has to be at the book value. So, of course, the cost will be book value. In the case of the depreciable asset, the cost of assets will be the WDV in the hands of the demerged company in case of block of assets. In case of the other asset, it will be the actual cost. Now, in the hands of the demerged company, what will be the cost? The WDV of the assets minus WDV of the assets that are transferred. For the assets which are used by both of them during the year, proportionate depreciation will be available. Fine. Then in the case of the shareholder, what will be the cost of the asset or cost of the shares which are issued in the resulting company? It will be the cost of acquisition of the shares of demerged company into the net book value of assets transferred to resulting company divided by net worth. Net worth is the paid up share capital plus general reserve. And what will be the cost of the shares of demerged company? It will be the cost of shares of demerged company minus the cost of shares that you have arrived for the resulting company. Now, the period of holding for the shares of resulting company, clubbing will be applicable, indexation, Manjula Shah applicable. Fine. Now, that is about the demerger. Again, in the case of demerger, the losses and the unabsorbed depreciation can be carried forward and set off by the resulting company. The losses for the remaining period and not for fresh 8 years. And there are no conditions like amalgamation. Now, in the case of demerger and amalgamation expenses, 35DD allows you the expenses over a period of 5 years. Then there are certain expenses like VRS, family planning, this scientific research, telecommunication deduction, preliminary expense, which are allowed to the amalgamated and the resulting company for the balance period if they are incurred by the amalgamating company. Similarly, if there is any expense which has been claimed and now the benefit is obtained by waiver or remission, then in that case, it will be taxable in the hands of the successor under 41(1). Yes, is it clear? Yes, students. Then we discussed conversion of sole proprietary concern to company, conversion of firm to company, conversion of company to LLP. For sole proprietary concern to company, all the asset liability should be transferred. Sole proprietor should be having more than 50% of voting power in the company for a period of 5 years and should not get any benefit other than the allotment of shares. For the firm to the company, again the same, all the assets and liability transferred, all the partners should become the shareholders in the capital ratio and no other benefit should be given to the partners. And finally, the partners' shareholding should not be less than 50% in the company for a period of 5 years. If these conditions are satisfied, it will be exempt under 47. In case you violate these conditions, then the capital gain exempted earlier will be taxable in the hands of the successor company in the previous year of violation. What will be the capital gain? The FMV of the asset minus the cost of acquisition. Fine. Now, in the case of the what will be the cost of the capital asset that has been transferred to the company? That will be the cost to the previous owner. So, clubbing of period of holding, indexation as per Manjula Shah applicable. For block of assets, it will be WDV. The depreciation will be on the proportionate basis. What will be the cost of acquisition of the shares of the company? It will be the value at which the shares are allotted. And the period will be from the shares when they are allotted. Fine. Then carry forward and set off of the business loss will be for a fresh period of 8 years. But if the conditions are violated, then the losses and which conditions? The conditions under 47. If these are violated, then the loss and the unabsorbed depreciation will be deemed to be the income of the successor in the previous year of violation. Fine. Then Conversion of company to LLP. What are the conditions? All the assets and liabilities are transferred. All the shareholders become the partners in their capital ratio, and TSR should be same in the ratio of the shareholding. Then no consideration other than the capital contribution and profit share. PSR should be more than 50% for 5 years. Total sales turnover or gross receipts less than rupees 60 lakhs in any of the 3 years. Total book value of assets less than rupees 5 crore in any of the 3 previous years of the company. And no other consideration is paid out of the accumulated profit for 3 years from the conversion. If the conditions are violated, then the capital gain exempted earlier will be taxable in the hands of the LLP, and the capital gain exempted for the shareholders will be taxable in the hands of the shareholders. Now, what will be the cost of the capital asset that has been received by the LLP? Again, cost to previous owner, 49(1), clubbing applicable of the period of holding, indexation, Manjula Shah. What would be the cost of acquisition of rights in LLP for the shareholders who are becoming now partners? The cost of acquisition of the shares. Period of holding of the shares will be clubbed. Fine? Yes or no? And then last, finally, we did the slump sale. What is slump sale? Slump sale is also again defined under 242C, meaning where an undertaking has been transferred for a lump sum consideration in any means without assigning the individual values to the assets and liabilities. Then the capital gain will be at a 50B. What will be the capital gain? Capital gain will be FPC minus cost of acquisition. Your FPC is as per rule 11 UAE, which is FMV1 or FMV2, whichever is higher. What is FMV1? FMV1 is A plus B plus C plus D minus L. A is the any other assets book value minus income tax paid plus income tax refund minus deferred expenditure. B is the value of jewelry in the open market as per valuation report. C is the value of shares as per rule 11 UA, which is again the fair market value. D is the immobile property, the stamp duty value. L is the book value of liabilities, but not including the share capital, the provision for dividend, any other provision, reserves and surplus, contingent liability, provision for tax, all of that is not included. FMV2 is E is the monetary consideration. F is the value of shares received, which is again as per rule 11 UA. G is the jewelry received, which is open market value. H is the immobile property, which is the stamp duty value. And then what is cost of acquisition? Cost of acquisition is my net worth. So net worth means the book value of assets minus the book value of liability. For the book value of assets, for depreciable asset, consider WDV. Goodwill, consider nil. Assets used for specified business for which you're claiming 3580, again nil. Ignore the revaluation. You will not get any indexation. The period of holding here you will consider for 36 months. If more than 36, long term, less than 36, short term. Yes. And then we solve a sum on the slump sale. Is the slump sale very, very clear? This is very important and an expected question always. Yes, students, all of you with me? Yes. Yes, yes, yes. I need the answers and the participation. Yeah, student, not getting any responses. Yeah. Yes or no? Is slump sale clear? Have you revised slump sale properly? Yes. Is slump sale clear? Very much. Shall we then proceed further, or you want to solve one more question on slump sale? Yes, good, Mohammed. You want to solve one more question on slump sale in case it is not clear? Or shall we proceed further? Geeta, do you want me to explain the slump sale again? Clear, Salish? Okay. So, slump sale, Geeta is saying that if I transfer an undertaking for a lump sum consideration without assigning the individual values, then that is slump sale under section 242C. Now, if it is a slump sale, the taxability is provided under 50B. It is very simple. Sale consideration minus cost of acquisition will be my capital gain. Now, what is the FPC here? FPC is higher of FMV1 or FMV2, whichever is higher. Now, if I tell you the example that we discussed in the last class, I'll tell you by that. So in case if you look at it, what is FMV1? FMV1 is the value of the assets of the undertaking as per rule 11 UAE. As per rule 11 UAE, it is the FMV of the assets. So FMV1 is A plus B plus C plus D. So FMV1 is the FMV of the capital assets transferred by way of slump sale. So if you look at over here, you can just write it. FMV1 is FMV of assets transferred by way of slump sale. So in the example that we discussed, this example, there what did we consider the FMV? The FMV of these assets which are transferred of the undertaking one. For building, it is stamp duty value. For other assets like machinery, debtors, it is the book value of the asset. For the income tax refund, you will add. Any income tax paid, you will reduce. Any deferred expenditure, you will reduce from the assets. That means you will not consider. For the shares, it is the fair market value as per rule 11 UA. Correct? For the jewelry, it is the open market value. So I will consider the assets from this balance sheet, which is the FMV of the assets transferred under the slump sale. That is my FMV1. Then what is my FMV2? FMV2 is the fair market value of the consideration received for the slump sale. So FMV2 is fair market value of consideration received. FMV1 is the fair market value of assets which are transferred. FMV2 is the fair market value of consideration that I am receiving. So, in case if you remember the question, the fair market value of the consideration received. How much consideration was received? 14 lakh. In this 14 lakh, the cash consideration was 10 lakh, which is E. F is the value of shares, fair market value of shares. So shares is 4 lakh. G is jewelry. We did not receive any jewelry. It's an open market value if it is received. H is the value of immobile property. What is value of immobile property that we have to take? The stamp duty value. So in FMV1, you consider the assets which are transferred, their fair market value. In FMV2, you consider the fair market value of the consideration which is received. So I have received 14 lakh. In 14 lakh, whatever I have received, I have to take the fair market value of that. Are we getting that? And then whatever is higher will be my FVC. For the cost of acquisition, what do I need to take the cost? Cost is the net worth. Net worth means what? Book value of assets minus book value of liability. Then I don't need to take any FMV. For the book value of assets, I need to take the book value. Only for the depreciable asset, you take the WDV. So here when we have got the patents, we had depreciated them because these were at the book values. The building was at the WDV only, so we consider the WDV. You have to ignore revaluation, so we ignore the revaluation in this example also. Are we getting that? So the net worth means the book value of assets minus book value of liability. Here you don't need to consider any fair market value, stamp duty value or whatever. Just for the depreciable asset, it will be WDV as per the Income Tax Act. Then you will not apply any indexation. The period of holding is going to be 36 months to decide whether it's a long term or short term. Period of holding of the undertaking. Yes, is it clear? Yeah. Yes, Sandhya, in the problem that we solved, we took the depreciation on the patents. So if you look at it, the patents are purchased in 2020 and we are computing for 23-24. So 2021, 21-22, 22-23 and 23-24. We have to take the depreciation for 4 years. Yeah. Okay, this should be unit was transferred on 1/4/23. 1/4/23. And yes, you are right, Sandhya. The depreciation should have been on the patents for 3 years and not 4 years. So this depreciation on patents should be for 3 years, which will be 105,469. So then your calculations will change over here. This will become 1,829,101. 1 second. For the shares, what is the fair market value? Is 2 lakh. This is 2 lakh. So this is 1 lakh only. The shares value is 1 lakh. This should be 1,655,469. 1,655,469. And accordingly, this should be 11,97,969. So your capital gain will also change. 11,97,969. This will be 994531. Okay. So yes, the depreciation on patents should have been for 3 years and not 4 years. Okay. Fine. So let's proceed further. Yeah. Okay. Now we are moving towards after the reorganization, again some smaller topics that we are going to consider. And then finally, if you remember, I told you we will have the tax rates, which is what we are going to discuss. And then of course the 54 series, which is going to be very simple. Fine. So if you see, we had divided the chapter into segments. First, we discussed what is a capital asset under 214. Then we discussed what is a transfer under 247, isn't it? Then we discussed about the short-term, long-term capital asset, which is there, the period of holding under 242A. Then we discussed about 45(1), the general charge. Then the specific charges which were there. So that is general and specific charge. General charge was first section with the definitions, and then the specific charge was the second part. Then we discussed about after the specific charge, the capital gain for the specific instruments, right? For the rights, bonus, ESOPs, all of that. And then we covered the period of holding. What will be the period of holding? What will be the cost of acquisition as per 49? What will be the cost of acquisition as per section 55? Isn't it? Then we covered of course, after that, the reorganization, which is amalgamation, demerger, conversion of company to LLP, transfer of capital assets by holding subsidiary, right? And vice versa. So that is entirely taken care of. Now the next part is the computation provision. And then finally the tax rates and then the exemptions. Yes. So now we are moving towards the computation of the capital gain. So now the computation of the capital gain, how will it be? Computation of capital gain. Yes. So now how do we compute the capital gain? Yes, tell me quickly, how do we compute the capital gain? Yes, students. How do we compute the capital gain? Yes, what is the formula? Yes, faster. This is very simple. Yes, students. So basically, if you look at it, the computation of capital gain is your full value of consideration minus the cost of acquisition, isn't it? So full value of consideration minus the cost of acquisition will give you the capital gain, isn't it? So yes, absolutely, Geeta. It is my FVC minus the cost of acquisition that shall give me the capital gain. So this computation is what we are going to look at it. For the FVC, we have for the specific sections, or you can write down, generally it will be my sale consideration which I am receiving, and then I have certain specific section. Now what are my specific sections? Section 50, C for the immobile property, section 50CA, section 50D, section 50, which is, yes. So all of these sections, of course, yes, you will also write about the slump sale because there also you have a specific provision for computing the sale consideration. So all of these are specific sections, isn't it? So basically this is 50B and not 50, it's 50B for the slump sale, isn't it? So basically you have these special provisions wherein you have the specific sale consideration. Even for that matter, you have 45(4), right? So there are various other sections. I'm just giving some examples where we have the specific provision for the considering the sale, isn't it? So basically what we have to understand is that this is the generally we consider the sale. Otherwise, we consider specific specific sections wherein the sale is defined. What shall be my sale amount? Isn't it? Now, if you remember, if you recollect, under 45(4), we had again the formula, isn't it? Under 45(4), we had the formula. So, that is something which has been specifically provided, isn't it? Under 45(1)(b), you had the formula for ULIP A minus B, amount received minus premium paid. There was a specific provision under 45(1)(b), isn't it? Then under 45(4) also you had similarly provision B plus C minus D, isn't it? So these are some wherein you have the sale consideration defined. Similarly, under 46(2), 46.2 was liquidation, where you used to reduce the 222C dividend, isn't it? Then in the case of the liquidation, you have like the reduction of that. Isn't it clear? So that is why I said that we have specific section. You can also add over here 45 1B and liquidation. (46.2). Similarly, for cost of acquisition, now cost of acquisition is defined. Cost of acquisition is defined under section 55. Under section 55, the cost of acquisition is defined. And how is that defined? The cost of acquisition for the different capital assets is given in a different way. For example, if you remember, I told you, cost generally will be the cost which has been incurred on the asset. But for specific assets like goodwill of business or profession or intangibles, it shall be nil. For the rights issue, it shall be the amount paid. For the bonus issue, it shall be nil. So the cost has been defined under section 55. For the cost of the asset which has been acquired from the previous owner, that is covered under 49. Are we getting that? So that is particularly defined under section 45 and 49 and 55. So generally it shall be my cost incurred. Otherwise specific is given under section 55 and section 49. Fine. Then you also reduce here the cost of improvement. So cost of improvement is also reduced here, isn't it? So any cost that has been incurred to make any additions, alterations, that shall be reduced. Fine. Also, one more thing over here, you also reduce the expenses on transfer. So expenses on transfer also you will reduce. I'm just taking it over here. Minus expense on transfer. So whatever expenses on transfer you are incurring, that also shall be reduced. So this is basically your computation of capital gain. Now, section 48. Section 48 talks about the mode of computation. So the income shall be computed under the head capital gain by considering these. This is provided under section 48. That the sale consideration minus expenditure incurred minus the cost and the cost of improvement. Now there are certain provisos which are included under section 48 for the purpose of the cost. That is what we are going to consider. And we have to look at section 50C, 50CA and 50D. This. Yeah. Now, first we will consider the full value of the consideration and then we will consider the cost of acquisition. So what is section 50C? This is IPCC topic. You have already studied very well. Yes. For the sale consideration, first is section 50C. Yes, you have to tell me. What is 50C? All of you know. This is an IPCC topic. Yes, faster. Faster, student. What is 50C? All of you know that. Please be participative. What is 50C? Yes. Students, please answer. Are you with me? Yes or no? Yes, students. Please answer. What is section 50C? All of you, yes or no with me? I'm not getting any answers. This is very important class, okay? Do not just sleep. It's Sunday, so you have to be alert. For us, there's no off. Yeah? Nobody is giving 50C. Have you not done it in IPCC? What is section 50C, students? Faster. Yeah. I'm not moving ahead in case you're not telling me. Yeah. Students, please be attentive and tell me what is 50C. All of you have done that. Not getting any responses. Yes, Geeta, it is for the immovable property. Right, you're correct. It is for the immovable property. So, for the section 50C, the 50C says that the stamp duty value of the immovable property shall be taken. So 50C says that the stamp duty value of the immovable property needs to be taken. Now, if you look at the stamp duty value, on which date you will take the stamp duty valuation? Yes. So you will take the stamp duty valuation for the purposes of immovable property as on the date of the transfer. So 50C says that stamp duty value shall be considered as the full value of consideration. But now understand one thing. Under 50C, there is some amount of leverage that is given, which is called as the safe harbor, which is given. Right? So what is that? So if the stamp duty value exceeds only 110% of the sale consideration, so always we do not consider the stamp duty valuation. If the stamp duty value is greater than 110% of the sale consideration, then only you consider the stamp duty value. If it is less than 110% of sale consideration, then you consider the sale consideration only. Fine. Now it is possible that the date of agreement may be different from the date of transfer. It is quite possible that the date of agreement, that the agreement may have been done earlier, and sorry, the agreement is done later on, but the transfer has happened earlier. So in that case, on which date you will consider the stamp duty value? So the agreement may be earlier and the registration may happen later. So the date of agreement may be different from the date of registration. So in that case, on which date we will consider the stamp duty value? So for that purpose, section 50C tells us that you need to check. You need to ask a question. In this case, just write down, if my date of agreement is different from date of registration, right? So the date of agreement and the date of registration are not the same. That is on which date or of which date the stamp duty value I will consider. So you have to ask the question whether consideration is received, whether the consideration is received by way of account pay check or account pay bank draft in electronic mode, right? On or before date of agreement. So you need to check what? That whether the consideration is received in account pay check or account pay bank draft or any other mode before the date of agreement, either in full or in part. Whether consideration, this is full or part. If your answer is yes, if your answer is yes, then you have to take the stamp duty value on the date of agreement. If your answer is no, then stamp duty value on date of registration. Are we clear? Yes. So this is how you have to consider the stamp duty valuation. So you have to consider whether the consideration is received by account pay check on or before the date of agreement. If yes, then the SDV on the date of agreement. If no, then the stamp duty value on the date of registration of agreement. Clear? Now, let's take an example to understand that. So let's say, for example, if my sale consideration is, let me write it here. If my sale consideration is 100 lakhs and let's say my stamp duty value on date of agreement is 109 lakh and stamp duty value on date of registration is, let's say, 112 lakh. Now, if let's say, for example, let's say 10 lakhs paid before the date of agreement. If the part of the consideration is paid before the date of the agreement, let's say by way of ECS. By way of ECS, the consideration has been paid. Okay, so then in that particular case, how will we consider yes? So students, you are required to give the answer. Are you with me? Please give the answers. Yes. So what will be your FVC over here? What will be my FVC? No, Sandhya. Read the question carefully. Yes, Geeta. Correct. Others, yes. What is the answer? See, if you do not reply, what will happen is you will make mistakes in the exam. It's better that you make mistakes over here so that you're corrected. Yeah. Yes, faster. This is very simple question. Okay, let me tell you. So, if you're not replying, see, I'm telling you that because you will not reply, there could be the possibility that you make mistakes in the examination. See, the answer, I know it already. And even if you make mistakes, there is no problem. Make as many mistakes as you want at the moment. But please revert so that you correct your mistakes. Okay. So here, if you look at it, this date of agreement is different from date of registration. So obviously, if the amount is paid before the date of agreement, we will consider the SDV on this date, on the date of agreement. So SDV on date of agreement is 109 lakh. But now if you consider this, you don't need to just take the SDV directly. What did I tell you at the first place? I told you that you have to see whether the SDV is greater than 110% of sale consideration. Here, the 110% of sale consideration will be 110 lakhs. So SDV is not higher than the 110% of sale consideration. So my FVC will not be SDV, but it will be the sale consideration only. So since the SDV is less than 110% of sale consideration, FVC is equal to sale consideration. But for the purpose of determining whether the SDV is less than or more than 110%, you need to decide which date you will consider the SDV. Yes, Vanshika, did you clear? Did you understand? So here the SDV is, though I'm taking on the date of agreement, but I still need to check that whether this is, so you can just make the chart like this, whether you have to take it as per 110% or it is less than 110%, you need to still decide that. Now, if let's say, for example, no amount would have been paid on or before the date of agreement, then in that case, since the SDV on the date of registration would have been taken, because let's say if no amount is paid on the date of agreement or before the date of agreement, Then in that case, 112 lakh we would have considered. So if no amount paid before the date of agreement, so we would have considered SDV on date of registration, which is 112 lakh. Now this SDV exceeds the 110% of sale consideration. So my FVC will have been 112 lakh. Yes, is it clear? So see, if you are making mistake in 50C itself, your entire computation will go wrong. Are we getting that? So you have to be very, very attentive as to what you are writing in your examination, because your entire computation will go wrong if you take the SDV wrong. Yes, students, is it clear? Okay. Now, there's one small another point over here. If let's say, for example, if the assessee disputes, the valuation adopted by the valuation officer, because there's a possibility that the AO may refer to the valuation officer, because the assessee may claim that the stamp duty value is not showing the correct fair market value. Okay. So it is possible where the stamp duty value may be higher than the fair market value. See, what happens is sometimes there are distressed sales. So there are certain, properties which are not getting sold due to certain reasons. Maybe it is at some isolated location, right? So in those situations, the stamp duty value may not be a correct reflection. And then the assessee may request to the AO that the valuation which is there, the fair market value of the property is much lesser than the stamp duty value. Are we getting that? So in that case, if the valuation officer's value is greater than the stamp duty value, then you will take the stamp duty value. If the valuation officer's value is lesser than stamp duty value, then you will take the value of the valuation officer. So just write down. If the assessee disputes the stamp duty value, AO may refer to valuation officer, as stamp duty value is greater than the fair market value. So valuation officer, if it is greater than the stamp duty value, you take the stamp duty value. If the valuation officer is less than the stamp duty value, you take the valuation officer. Fine. Okay. So that is the small point which I wanted to discuss. Now a similar provision exists under PGBP as well, which we have not discussed in the PGBP class in detail. But if you remember, I had made a mention of that in PGBP also. So what was that? What was the similar provision which exists in PGBP as well? Section 43CA. Section 43CA. If you remember, there was a similar provision under PGBP 43CA, which we had not discussed in, of course, detail therein, but it's the same as the 50C, which is saying that if the land and building is held as a stock in trade, now if that land and building is sold, then the income will be chargeable under PGBP. Correct? And not under capital gain, because I'm doing the business in land and building. I'm a real estate agent, or sorry, real estate developer. Now, if that land and building is sold, you have to take the same stamp duty value. Stamp duty value, if the stamp duty value exceeds 110% of sale consideration. Otherwise, you take the FVC as the sale consideration. Now, if the date of agreement is different from date of registration, then you have to see whether the consideration is received whole or in part before the date of agreement through the account paid check or electronic mode. If the answer is yes, stamp duty value on date of agreement. If the answer is no, stamp duty value on the date of registration. So this was a similar provision under PGBP, which is section 43CA. Clear? So I just wanted to highlight that. Now, next particular section is the section 50D. 50D is the fair market value. So where the consideration is not ascertainable, then the fair market value will be taken as the full value of consideration. So in case you are unable to ascertain the fair market value of any asset, of any other capital asset, then you take the FMV. Are we clear? So just write down, if the consideration is not ascertainable, where the FVC is not ascertainable for any capital asset, FMV on the date of transfer shall be my FVC. Okay, this is as per section 50D. This is for any capital asset. Fine. Now the last one is for shares. But which shares? This is for the specific shares, for the unquoted shares. For the unquoted share. So you can just write it over here instead of shares, for the unquoted shares. We have section 50CA. Are we clear? Now, here you need to ask, what is the meaning of quoted share and unquoted share? So the quoted share means the shares which are quoted on a recognized stock exchange. So therefore, the shares which are not quoted on a recognized stock exchange are unquoted shares. Are we getting that? So the shares which are not quoted on a recognized stock exchange are, even though they may be listed shares, but these are not on the recognized stock exchange. So then, in that particular case, that will not be considered as the quoted shares. Clear? So those will be still considered as the unquoted shares. So even though they may be listed, but they will not be considered as the quoted. Clear? So in that particular case, 50CA says that what will be my full value of consideration? So 50CA says that the full value of consideration in this case will be the fair market value. 50C says that it will be the fair market value. It will be the fair market value if it is less than the sale consideration. So if the fair market value, if the sale consideration is less than fair market value, you can write like this. If the sale consideration is less than fair market value, yes, so then take the fair market value. Fair market value on the date of transfer. Okay. So fair market value, if the answer is no, then it will be sale consideration. Now this fair market value will be as per rules. This is going to be as per the rules. Now, for the purposes of 50CA, this is as per Rule 11UA. This is as per Rule 11UA. So, Rule 11UA will give you the answer for this. So, in case of the shares which are transferred, if these are unquoted shares, meaning the unlisted or not listed on a recognized stock exchange, so then in that particular case, it will be as per Rule 11UA. Now, how the Rule 11UA gives a valuation, that we will discuss. But this will not be applicable to, so there is an exception to that. So this is not applicable to the following situations where the shares are transferred. Where the shares are transferred by a subsidiary. Okay, this shall not apply to the transfer of any shares of a company and its subsidiary where the insolvency proceedings are going on, or where the board of directors have been suspended by the way of insolvency proceedings. So this is not applicable to the share transfer under IBC, Insolvency and Bankruptcy Code. Fine. Okay. Yes or no? Fine. Yes, students, any doubt? So this is about section 50CA, 50C, 50D. Okay, now what is the fair market value as per Rule 11UA? Now what does Rule 11UA says? It says that the value of the unquoted shares, now it could be equity, it could be the preference shares. So for the, as per Rule 11UA, we will have, if it is equity shares, and the second scenario is where it is other than the equity shares. So maybe the preference shares. So for the preference shares, it is simple, right? It would be the open market value. It would be the open market value based on valuation report. Based on the valuation report, it will be the open market value. Fine. Now, for the purpose of the equity shares, what is going to be the valuation? So, for the equity shares, it will be again a formula, which is A plus B plus C plus D minus L into PV divided by PE. Now, if you understand this, you don't need to remember the formula. It is same like slump sale only. The formula is exactly same what you understood for slump sale. What was A in the slump sale? Yes. What was A in the slump sale? Yes, students, now I need your answers. What was A in the slump sale? It's exactly the same. What was A in slump sale? Yes. What was A, students? Faster. What was A? Yes, Geeta. Any other asset. So for any other asset, What was the valuation? The book value. Right? Here you will not consider the income tax paid. You will add income tax refund and you will reduce any deferred expenditure which is unamortized. Then what was my B here? So my B was the value of the jewelry. So here, yes, it is the same jewelry which will be my open market value. C was my shares and securities which will be the fair market value as per Rule 11 UA. D was the immovable property, which was what? My stamp duty value. L was my book value of liabilities. Excluding again over here, paid up share capital, reserves, then provisions, and contingent liabilities, right? All of that is completely same over here. Just that you have the into PV divided by P. So my PV is the paid up value of equity shares. And P is the total paid up equity share capital. That's it. So this is exactly same as slump sale. Only that you have to do PV divided by P, which is paid up value of those equity shares divided by the total equity shares paid up value. Clear? Yes or no? So this is about section 50C. Sorry, 50CA. Fine. Now next one is going back to the cost of acquisition. I'm going back to my cost of acquisition. So what did I tell you? Section 48 of the Act provides for the computation of the cost. Now for the purpose of section 48, as I told you, there are several provisos which are given. Now we recognize it one by one. What does section 48 say? That we are going to consider one by one. Now, first section 48 says is, the first thing section 48 talks about is the first proviso to section 48. Just write down. Section 48. So, my first proviso to section 48 talks about the interest deduction. Now, this is the recent amendment which has been made under the Income Tax Act. What is this recent amendment? Let's try and understand. So, section 48 says that when you are taking the cost of acquisition, when you are considering the cost of acquisition or the cost of improvement, that shall not include the deductions claimed on the interest under section 24B or chapter 6A. 24B, what was it? So 24B is the interest claimed under the head house property. So that, you know, what the people were trying to do is, they were trying to claim the deduction of interest first when the house is purchased under the head house property. Right? So you claim the deduction of interest whether it is self-occupied or whether it is let out. You claim the interest deduction under 24B. Isn't it? So they were claiming the interest under 24B, And then when they were selling the house, again, they were taking it as the part of the cost of acquisition. Okay. So first they were trying to claim the deduction under house property when they were purchasing the house. And again, they were claiming it as a part of the capital gain. So in order to avoid that double deduction, it has been provided that this is the recent amendment, proviso, first proviso to section 48. Interest deduction claimed under section 24B or chapter 6A not allowed as deduction. Or you can just write down not to be considered as cost. This is Finance Act 23 Amendment. So, but if you can, just ask me a question, ma'am, what if we have not claimed the deduction under house property? It is possible, right? So only for a self-occupied property up to 2 lakhs interest deduction is allowed. So the balance amount that you are claiming, that you obviously carry it forward to the future year. But in case you're not carrying it forward, and let's say, for example, you have never claimed that deduction of the excess amount, that you can obviously recognize as the cost because that has not been claimed as deduction under 24B. Are we getting that? So, in case you have claimed the deduction, then there is no problem. Then you cannot consider that as cost. But if you have not claimed the deduction, if there is a restriction of 2 lakh rupees, so over and above that amount which is there, that you will of course claim it here as the cost. So here what is important here is interest claimed as deduction under 24B. So interest not claimed as deduction, you can obviously take it as cost of acquisition. Clear? So interest, you can write down not claimed, that is greater than rupees 2 lakh for self-occupied property, can be taken as cost of acquisition. So this is the first proviso to section 48. Then there is another amendment which is in respect of the cost of acquisition of a unit of business trust. Now that we are not going to deal here. That we are not going to consider at the moment. Because when you will go to the assessment of various entities class, at that point of time, I will take that into consideration. Clear? So at the moment, I'm not touching upon that. Clear? So that we will take care separately in the assessment proceeding class. So that is the, again, explanation to the first proviso, or explanation to section 48.1. Then you have the second proviso. You have the second proviso to section 48. Or first proviso to 48 and not second proviso. The first proviso to 48.2 is this particular point, interest deduction. So this is first proviso to section 48.2. But then you have first proviso to the 48th section. So that is the proviso to the 48.2. Or you can just remove the word first in order to avoid confusion. So 48.2 talks about what is the cost of acquisition. So it says interest cannot be cost. But the first proviso to 48 talks about giving the exchange rate fluctuation benefit in case of the non-residents. In case of the non-resident. Now, this again we are going to separately consider in international tax class. In international tax class, this is again we are going to separately consider for the non-residents. So at the moment, we are not touching upon this aspect as well. Clear? Then the second proviso to section 48 says what? Second proviso says consider indexed cost of acquisition and indexed cost of improvement. In case of long-term capital gains. In case of long-term capital gains. In case of long-term capital gain. So, substitute the cost and the index cost in case of a long-term capital gain. The index cost and index cost of improvement will be considered. Except in situation where first proviso is applicable. So, first proviso, which is exchange rate fluctuation benefit to non-resident, in that case, you cannot claim the indexed cost. Clear? So for a long-term capital gain, you have to consider the indexed cost. Now, there are, as I said, the exceptions to that. Exceptions are Section 50A, Section 50B, right? So slum sale, your Section 50, which is the depreciable asset when it is transferred, or the power generating unit asset which is transferred, right? Where you claim the balancing charge for Section 50 or Section 50AA. In these cases, you cannot claim the indexation. You cannot claim the indexation. Isn't it? You cannot claim the indexation in these situations. Fine. Then, what is the proviso, third proviso to Section 48 is saying? That says that the indexed cost, so second proviso to 48 says that the indexed cost has to be taken. Now, the benefit of indexation will also not be given to the sovereign gold bonds and the capital index bonds. So here you can write down the exception also is sovereign gold bonds and the capital index bonds. Fine. Now what is the indexation for this year? Indexation for 23-24 is 348. Is going to be 348. Okay? Yes. Fine. Then section 48. The third proviso also says that the second proviso says that the indexation will be applicable for a long-term capital asset. But the third proviso says that the foreign exchange fluctuation benefit, first proviso, indexation benefit, second proviso, shall not apply to the transfer of a listed equity share or equity oriented fund to which 112A is applicable. To which 112A is applicable. So in these situations, you will not get the benefit of 112 and 112A. Sorry, 112A, not 112, 112A. So basically, here you can write under exception again. Let me just remove this. That's it. Some issue. So indexation for financial year 23-24 is 348. Here you can write that foreign exchange fluctuation benefit and indexation not applicable to section 112A. So 112A is transfer of listed shares and listed equity oriented fund. Okay. Then it says that, then what additionally it says? That in case of a non-resident, any appreciation on the rupee against a foreign currency at the time of redemption of rupee denominated bond will be ignored. This we have done, right? Remember when I was talking about rupee denominated bond under special instruments? Under special instruments, we have already done that in case of a non-resident, the appreciation on rupee will be ignored. This we have already done here. If you remember there, rupee denominated bond. Appreciation of INR between the date of purchase and date of redemption not to be included in the consideration. In case of a non-resident, you can, here I have written, in case of a non-resident, any gain on the appreciation of rupee against the foreign currency at the time of redemption will be ignored for the full value of consideration. So this is coming through section 48. So just write down over here, that is not as a part of the cost of acquisition, but the sale consideration. So just write over here. Give me a minute. Yeah. So you can just write it over here for the sale consideration. Appreciation on INR in case of rupee denominated bond issued to non-resident not to be considered in FBC. Refer rupee denominated bond tax. Fine. Clear? Yes, students? Okay. Now, next one important last point here. In the cases where the transfer has been happening, of shares, debentures under the gift or a will, if the transfer has been happening of shares or debentures, then the market value shall be deemed to be the full value of consideration. Now, if the gift is taxable, so where the shares, debentures which are there, which are basically transferred under the ESOP's plan, when the shares are gifted under the ESOPs, right? So basically what happens is, when you give the gift or when you transfer under a will, then that is exempt under 47. That is not considered as transfer. But when the transfer is happening under a gift of the shares or debentures allotted by a company to the employees under the ESOPs. So when the transfer is happening under a gift of the shares which are allotted under the ESOPs plan. So let's say, for example, I've got the shares under the ESOPs. Now that I am giving it as a gift. So that is not exempt. So yes, the transfer of capital asset is exempt. But you can just write down over here where we had written the gift, right? So there you can just write down this point. We have not written about the gift or what? I think we had written somewhere. 1 second. Yeah. Transactions not regarded as transfer under 47. So there, if you remember, I had told you that the transfer under the gift or the will is not considered as a transfer. Transfer of capital asset under gift or a will is not considered as transfer. There you can just write down. Here you can just write it. Transfer of capital asset under gift or will, right? Not transfer under section 47. And this is going to be applicable to them. Okay. Now, but you can just write here an exception. You can write the exception over here. Give me a minute. Yeah. Here you can also write about transfer of capital asset under partition of HUF. That is also not considered as transfer. Then transfer of capital asset under gift or will. In this situation, the exception is transfer of capital asset being shares or debentures allotted under ESOPs. Allotted under ESOPs. In that situation, the full value of consideration for shares or debentures under ESOPs shall be the market value. Shall be the market value, okay, on the date of transfer. Is this clear? Fine. Now, last point under section 48. Last point under section 48 is the STT is not allowed as the deduction. STT is not allowed as deduction. Now, if you look at PGBP, if let's say, for example, I am dealing in shares, then it will be my PGBP, except if it's an FPI. If it is an FPI, then of course, even if I'm dealing in shares, that will not be considered as PGBP. It will still be taxable under capital gain. But in case where I have the PGBP, then in that case, if you remember, under section 36, there was a specific deduction for the security transaction tax. But under the head capital gain, you will not get any deduction for the security transaction tax. Are we clear? So in that particular case, you will not get any benefit of the security transaction tax deduction. So just write over here. No deduction for the security transaction tax. No deduction for the STT. Okay. Yes. Also here you can write down this foreign exchange fluctuation benefit and indexation not applicable to non-resident, claiming 10% rate under section 112, not 112A, under section 112 on unlisted securities under section 112. So to them also, the first and second proviso is not applicable. And finally, section 48.3, if you remember what was 48.3? Yes, students, what was 48.3? Yes, what was 48.3? Yes, students, faster. What was 48.3? Faster. 48.3 students, let me know what was it. 48.3. What was 48.3 students? Faster. Yes. 48.3, anyone? What was it? Forty-eight-3 was, yes. Fast answers. This should be on the tip. Nobody is answering. All of you are sleeping on Sunday. Yes. Wake up, students. What is 48.3? We are not going to have a break if you are not going to give me answer on 48.3. Go back to your books if you do not recollect, but this should be on the tip, as I said. Yes, faster. 48.3 was the amount attributable to section 45.4 and 9b. Right? The amount, sorry, not 9b, the amount attributable to the capital asset which has been charged under 45.4 that was given the relief under 48.3. If you remember. Yes? So that is something the 48.3 gives the deduction. And read with the rule 8ab. So just write down minus amount attributable to capital asset charged under section 45.4. This has to be read with rule 8ab. Okay, so let's take a small break of 10 minutes and then we get back. Let's take a break. Yeah. Now, this is going to give you the capital gains. Okay, this is going to give you the capital gains. Now, we will come to the tax rate. Okay, also one more thing from this capital gain, once you compute this capital gain, so if you remember section 45(1), what did it say? It said that profit or gains arising from the transfer of a capital asset, right? Profit or gains arising from the transfer of a capital asset, except in the cases where you are claiming the exemption under 54 series, will be chargeable to the capital gain. So from the charging section itself, the 54 series which are there, these are going out. So if you have the exemption under 54 series, then you will not come within the charge itself. So capital gain minus exemption under section 54. Fine. Now this we are going to learn later, the 54 series, but first we are coming to the tax rates. So the next topic is tax rates. Okay. Now capital gain, for that we have the tax rates given under 111A, 112 and 112A. So that is what we are going to now look at it. We have done the computation. Now we have the capital gain, tax rate. So now tax rate depends on whether the capital asset is a long-term capital asset or short-term capital asset. If it is a short-term capital asset, and if the capital asset is covered under 111A, what is 111A? So section 111A is the special tax rate for listed equity share, right? Listed equity share or equity oriented fund or unit of business trust or unit of business trust on which STT is paid, on which the STT is paid, then this will be taxed at the rate of 15% under section 111A. This shall be taxed under 111A at the rate of 15%. Clear? Now, here you have to note certain points. The first point being, here you will also have the transactions undertaken on a recognized stock exchange, and where the consideration is paid on the recognized stock exchange in IFSC, and where the consideration is paid in the foreign exchange. So even if on that transaction STT is not paid, even that will be covered under 111A. Because on the recognized stock exchange in IFSC, STT is not applicable. But that doesn't mean that will not be covered under 111A. So STT is paid plus transaction undertaken on recognized stock exchange in IFSC plus consideration paid in Forex. Fine. Then you have 111A applicable. Now, in case you are individual or HUF, resident individual or HUF can utilize the unexhausted basic exemption limit. Okay. So in case, let's say for example, I have 3 lakh rupees as my income, right? I have 3 lakh rupees as my income. So not 3 lakh, let's consider maybe my income is, let's say, 2.5 lakh. So now the 2.5 lakh, out of that, let's say 2 lakh rupees is the interest income, 50,000 is the short-term capital gain. Now, if that be the case, the 2 lakh I will utilize against interest income. The 50,000 which is remaining, or let's say my income would have been 3 lakh. Out of that, 2.5 lakh would have, 2 lakh would have been interest. 1 lakh is short-term capital gain. So out of the 2.5 lakh slab rate that I have applicable, the 2 lakh would be utilized against the interest income. The 50,000 will be utilized, which is the unexhausted basic exemption limit, will be utilized against the capital gain chargeable under 111A. So I can utilize the unexhausted basic exemption limit. Last point, Chapter 6A deduction is not applicable on 111A. Chapter 6A deduction is not applicable on 111A. In case it is other asset other than this, any other asset, then normal rates. So for individual, we will have slab rates, and for the others, we will have the tax rate which is applicable to them. Clear? Now coming to the long-term capital asset. Now long-term capital asset, we have the tax rate either under 112A or under 112. Okay. So now first we are going to deal with 112A, and then we have section 112. Now first we are going to talk about section 112A. Now section 112A, which is there, that is applicable on which kind of asset? That we have to first consider. Now that is applicable to what? The 112A is applicable to listed equity shares, equity oriented mutual fund, and the units of business trust. Okay, so or you can just write it like this, the same way we wrote it for listed equity share. So 112A is applicable on listed equity share, equity oriented mutual fund, units of business trust. So in these cases, the 112A is becoming applicable. Okay. Now, equity share, equity oriented fund, and units of a business trust. Now, the condition is that on the equity share, the STT should have been paid on the purchase as well as transfer. So, on which STT is paid at time of purchase plus the transfer. And in the case of listed equity oriented fund and listed units of business trust, STT is paid at time of transfer. STT is paid at the time of transfer. Now, this shall not be applicable in a case where the transaction is taking place on a recognized stock exchange in IFSC and where the consideration is received in foreign exchange. Yes, here also you can write down the listed. Here also it is listed because if the STT is applicable, it is obviously listed, but you can just write down. Okay. So, STT is paid at the time of transfer. Exception. Transaction on recognized stock exchange in IFSC where consideration paid is in foreign exchange. Okay. Now, if this is the situation, the tax will be tax at the rate of 10% on capital gain exceeding rupees 1 lakh. On capital gain or LTCG exceeding rupees 1 lakh. So if let's say my capital gain is 3 lakh rupees, on 2 lakh rupees, I will have the 10% tax rate. Are we getting this? So basically, I will have the tax rate on the amount which is exceeding rupees 1 lakh. Clear? Now, there is one more exception over here. The STT, even if it is not paid at the time of purchase or at the time of transfer, but if it is covered in notification, issued by central government, dated 2000 or notification of 2018. You can just write down notification of 2018 issued by the central government. Now, what is this notification? We'll talk about it. But the point here is if it's a listed equity share, listed equity oriented fund and the unit of business trust, then in that particular case, you will have the long-term capital gain taxed at 10% over rupees 1 lakh. But the STT should have been paid at the time of purchase and transfer in case of the listed equity share. For the equity-oriented fund and the units of trust, business trust, it will be at the time of transfer. STT should have been paid at the time of transfer. Again here, the resident individuals or HUF can utilize unexhausted basic exemption limit. So just like your short-term capital gain, here also you can utilize the basic exemption limit for the capital gains exceeding rupees 1 lakh. See, capital gain till rupees 1 lakh are any which way is not taxable. It is the capital gain over rupees 1 lakh which will be falling within the total income. And for that, you will have the tax. You will have the basic exemption limit counting. So let's say, for example, if I have exceeding rupees 1 lakh. Let's take an example. Let's say my long-term capital gain is rupees, let's say 3 lakh. My interest income is, let's say, rupees 2 lakh. Fine. So my total income will be 5 lakh. Now, when I take the basic exemption limit, 2 lakh interest is exempt. Sorry, 2 lakh interest will first go, right? So remaining basic exemption limit will be 50,000, right? Out of the 2.5 lakh. Now this 50,000 I will apply for 2 lakh, which is 3 lakh minus 1 lakh capital gain. Are we getting that? So then only 1.5 lakh, which will be taxed at 10% under section 112A. Yes, are we getting that? Fine. So this is how it shall be. So resident individual or HUF can utilize the basic exemption limit, which is unexhausted. Now you will not get any chapter 6A deduction. So here also no chapter 6A deduction, no rebate under section 87A. Here you will also not get any rebate under section 87A. Clear? So no chapter 6A deduction, no rebate. For rebate, nothing is mentioned under 111A, but under 112A, it is specifically mentioned that this will not be considered. Fine. Any questions so far? Any doubts? Any questions? Okay. Now understand one very important thing. Before we move to a notification, we have to understand one very, very important thing. And you have to answer it. What is equity-oriented mutual fund? Which equity-oriented mutual fund is going to be covered over here? Yes. Remember, while we were dealing with section 50AA, we have dealt with this particular situation. No, Chirag, first you cannot utilize the basic exemption limit against LTCG because LTCG is taxed at a special rate. So you can only utilize the balance basic exemption limit which is remaining. Because the LTCG is taxed at a special rate, there is no basic exemption limit which is applicable for the LTCG. It is taxed at a flat rate. Whereas interest is going to be taxed at a slab rate. So you cannot utilize the basic exemption limit against that. But what the provision says is that let's say if you have certain unutilized basic exemption limit, you can use it over here. Clear, Chirag? Yes. So what is my equity oriented fund over here? Section 50AA. Yes, Vanshika. Very good. So if you remember, under section 50AA, while we were dealing with these securities, if you remember, there's some lag here which is happening. 1 second. Yeah. So if you remember, I had given you the chart over here that up to 35% of the equity, the mutual fund is investing in equity shares, and it is up to 35% of equity shares, then it will be taxable under 50AA as the specified mutual fund, wherein the gain will be deemed to be the short-term capital gain. If it is between 35% and 65%, it will be considered as debt-oriented fund, and the period of holding will be 36 months. And the long term will be taxable under 112. The short term will be taxable under normal rates. If it is more than 65% of equity and or greater than 90% in another mutual fund, then it will be regarded as equity-oriented mutual fund. The period of holding will be 12 months and tax under 112A or 111A for short-term capital gain. This is for LTCG. Clear? So this is what is the equity-oriented mutual fund under 112A. Here you can write STCG at normal rates. So equity-oriented mutual fund, which is referred under 112A, is the mutual fund where I'm investing 65% of the proceeds in the equity shares of the listed equity shares. Or if I'm investing in another mutual fund, then 90% is invested in the units of the other fund, and that mutual fund will invest 90% in the listed equity shares. Okay. So only in that situation, this will be considered as the equity oriented fund. 65% of, you can write it over here, listed equity. Listed equity. Okay. Are we clear? So under 50AA, we only have less than 35%. Under 50AA, it is less than 35%. Okay. And this, for the equity oriented fund, this should be more than 65% in listed equity. Clear? Now, what I said is that for the 112A to be applicable, you should have the STT paid at the time of purchase as well as transfer in the case of listed shares, and in the case of equity oriented fund and the unit of business trust, the STT should have been paid at the time of the transfer. Now, there is an exception. The first exception was the transaction is on a recognized stock exchange in IFSC, where the consideration is paid in Forex. The second exception is if it is covered in notification issued by the central government, the notification of 2018. Now, what does this notification talks about? Now, this notification gives us the scenarios where it is possible that at that point of time, the STT may not have been paid. The STT may not have been paid at that particular point of time. So then in that particular situation, the notification covers those exemptions or covers those situations where the STT is not active, not at all applicable. Now, what are those situations? Let's try and understand. Because see what happened, there are certainly genuine transactions where STT is not applicable. Because, the reason or logic behind this is that initially what used to happen is that prior to 2018, the shares on the listed shares which were transferred, the capital gain arising on the listed shares used to be exempt under the erstwhile 1038 section. It used to be exempt. To give a boost to the stock market, the listed equity shares, the capital gain arising on the listed equity shares used to be exempt. But slowly it was realized that the people started misusing 1038 exemption. 1038 is a section. So the government revoked the exemption and introduced the concessional tax rate of 10% on the long-term capital gain on the listed equity shares. Because earlier long-term capital gain on listed equity shares was exempt. And the government realized what these taxpayers were doing is they used to purchase certain penny stocks. What is penny stock? Penny stocks are the stocks of the company which are having very low valuation at the outset. So they will, purchase it as the unlisted share. These companies are not listed, these are unlisted when they are purchased, when the taxpayers purchase these shares. Now they purchase, let's say for 1 rupee, 2 rupee, 5 rupee, 10 rupee, like that. These are called as penny stock. And what this company will do is they will collect the money from the taxpayers and then go for the listing. Now, once it goes for the listing, the share price will automatically go higher. And at that time, they will, let's say, sell the shares for 1,000, 2,000 rupees. And by this means, what they will do is when they purchase the shares at that time, it was off-market transaction, it was unlisted company. Now, when they are selling the shares, at that time, they are making huge profits, and this would still be exempt if it is a long-term capital gain. Short-term capital gain was any which was taxable under 111A always. But long-term capital gain, they used to claim this exemption. So in order to take these transactions out of the purview, there is this condition which has been introduced, which is that the STT should have been paid at the time of purchase as well as at the time of sale. Only then you can claim the concessional tax rate of 10%. But now what will happen? The penny stock transactions, which are first purchased as the unlisted shares and then they are listed and then they are sold, that will obviously not be covered under 112A. But what will happen is, even the genuine transactions will go outside the purview of 112A. Where STT is not applicable genuinely. What are the examples? Bonus issue, rights issue, ESOPs, amalgamation, demerger. You get the shares, but do you get it through a stock exchange? Answer is no. You don't purchase it through a stock exchange. So obviously STT will not be applicable on that. Only on the stock market transaction the STT is applicable. So now these are the genuine transactions, but we are still taking them outside the purview of 112A. So that is why the central government has issued a notification in this regard, and they provide that list of transactions where even though STT is not applicable, still it will be considered as the genuine transactions for the 112A. So the requirement of paying the STT at the time of acquisition for availing the 112A concession will not apply. Are we getting that? So what are these transactions? Where, let's say, for example, the acquisition of the listed equity share has been approved by the courts or the National Company Law Tribunal or RBI, or the shares are issued under FDI guidelines, or let's say, for example, the shares are issued under the ESOPs, the shares are issued under the gift of shares has been made. There is a transfer of capital asset between the holding company to subsidiary or subsidiary to holding company under 47.4 and 47.5. Amalgamation, slump sale, introduction of a capital asset being shares by the partners as a capital contribution under 45.3, or on the retirement of the partner or on dissolution, shares are given to the partner under 45.4. Isn't it? So in these cases, obviously the STT will not be paid. So in that case, this is covered by the notification. So just write down the genuine transactions like genuine transactions like purchase of ESOPs, bonus, rights issue, amalgamation, demerger, or purchase of capital asset by holding company from wholly owned subsidiary or vice versa. Capital contribution by partner or distribution by firm to the partner. Right? In all these situations, there is no applicability of STT. Slump sale. So there is no question of the STT being applicable. Clear? So these are covered under the notification. Clear? Yes or no? Now, how do we calculate the capital gain over here? Now, again, for this purpose, the capital gain computation differs a little bit. The capital gain computation differs a little bit. So how do we calculate the capital gain over here? So in this particular case, The cost of acquisition is something we have to take into consideration. The cost of acquisition is something that we have to take into consideration. So, section 55 talks about the cost of acquisition. What it says is, in the case of the listed equity shares or equity-oriented mutual funds, since this provision was introduced in 2018, since this provision was introduced in 2018, there is a grandfathering benefit which is available in respect of the cost of acquisition. Because see, as I told you, prior to 2018, the long-term capital gain were exempt. It is only after 1st February 2018 that the long-term capital gain is taxed at 10%. So obviously, if I, let's say, I purchased the asset prior to February 18, and now I'm suddenly taxed on the sale, there should be some benefit given to me. So a grandfathering benefit is given to the assessors. So how is it calculated? Let me show you. So capital gain will be equal to full value of consideration, which will be my sale consideration, minus the cost of acquisition. Now, what will be my cost of acquisition? That we have to understand. How do we determine the cost of acquisition? So, if assets acquired prior to 31st January 2018. Okay, if the assets are acquired prior to 31st January 2018, or if assets acquired post 1st February 2018. Now, if the assets are acquired post 1st February 2018, this will be very simple. This will be the cost of acquisition, the actual cost. If the shares are acquired prior to 1st February 2018, which is 31st January 18, then in that case, how will the actual cost be computed? Now, you have to take into consideration three things. What are those three things? Let's try and understand. So, first of all, you need to consider the higher of the A or B. Higher of A or B. A is my actual cost of acquisition, or you can just write it like this. Higher of A or B. Now, A is my cost of acquisition and B is lower of sale consideration and fair market value, lower of sale consideration and the fair market value on which date? As on 31st January 18. As on 31st January 18. So basically what you have to consider is, first you have to see the actual cost, then you have to see the fair market value. Okay. So then the higher of the actual cost or the fair market value as on 31st January 18. Sorry, higher of the A or B. A is the actual cost, B is the lower of the sale consideration or the fair market value, whichever is lower, that shall be taken, and then the higher of the A or B shall be taken. Okay. And then the higher of A or B you will consider. So this is how you will calculate the cost of acquisition for the assets which are acquired prior to 31st January 18. Now, what is the FMV as on 31st January 18? Again, we will see what is it. So, what is going to be the FMV? So, FMV here will be FMV as on 31st January 18. Again, that is defined. What will be my FMV? So, FMV is same calculation almost like you used to have for the ESOPs. You remember for the ESOPs, we had the FMV as on the date of perquisite, FMV as on the date of exercise when you are considering the perquisite under section 17, isn't it? So here also the FMV is more or less similarly calculated. So the FMV, this is given under section 55. Okay, this entire is given under section 55. The cost is defined under section 55. So FMV here will be in case of listed share. In case of the listed share, then the highest price on set date. If there is no trading, then the highest price immediately before that date. Okay, so highest price of the share. In case it is not listed, unlisted, then the net asset value. Then you take the net asset value. Unlisted, mutual fund or units of business trust. In case of the unlisted equity share, then in that case the cost of acquisition into CII of previous year 17-18 divided by CII of previous year in which share is acquired. Okay. Fine. So in this case, it will be CII will be considered over here. So this is the fair market valuation. Fine. Now understand one thing. If the assets are acquired prior to 31st January 18, you have this. But if it is post 1st February 18, then you will of course take the normal cost of acquisition. Now let's take an example to understand this. You have to tell me the answers for these examples. Okay, but before we move on to example, one more last point on this particular question. Here, whether the cost of acquisition will be indexed, answer is no. If you remember, I told you just now under section 48, if you are computing the capital, if your capital gain is taxed under 112A, then indexation or first proviso to section 48 is not applicable. So you will not get any benefit of the indexation over here. You will not get any benefit of the indexation. Are we clear? Now, what will happen in the case, let's say, for example, I have the bonus shares acquired before 1st February 18. Or I have the rights shares acquired before 1st February 18. Now, these, any which ways, bonus issue do not have any cost. If you remember, I told you for the bonus issue, the cost is nil. So, what will be the cost in the case of bonus shares? So in that case, for the bonus shares, the cost of acquisition which is there, The fair market value as on 31st January 18 will be taken as the cost of acquisition. In case of bonus shares, the cost of acquisition will be the fair market value or the nil, whichever is higher. So if you remember, while we were dealing with the bonus shares, I gave you the same point over there as well. Let me take you back and see, this is how you have to remember the things. You have to keep on referring again back and forth. Otherwise, you will forget. So see, bonus shares allotted before 1st April 2001, the beneficial one has to be taken either the FMV as on 1/4/2001 or nil. Then in the case, this should be FMV as on 1/4/2001. In case it is allotted before 1st February 18, then you take the nil or FMV if the purchase is prior to 1/4/2001 and lower of FMV as on 31st January 18 or the sale consideration, whichever is lower, and the higher of nil or the amount that you get over here. So any which ways, for the bonus issues also, obviously the nil amount will not be higher. Obviously the higher amount will be either the FMV or the sale consideration. So only that will be considered. Isn't it? So for the bonus issue, if the cost of acquisition is nil, how will you calculate? You will calculate as per this particular provision under section 55 only. If it is allotted after 1st February, the bonus issue, the cost is nil. Similarly, in the case of the rights issue, again you will apply the same scenario. So for the rights issue also, whatever cost you would have paid to acquire the rights, that you will consider, and then the higher of fair market value and the lower of the fair market value and the sale consideration, and the higher of the cost or this amount, whichever will be higher, you will take into consideration. Clear? Any questions? Any doubt? Okay. So just write down over here for the bonus issue. You can write over here. For bonus issue, refer tax on bonus shares. Consider the same. For bonus share also, you have to consider in the same manner. Clear? Now, next important point is you will solve the examples. So, let's take a scenario for, let's say, where the equity share is acquired as on 1st January 17 at rupees 100. So, let's say equity share acquired on 1st January 1700. Fair market value as on 31st January 18 is 200 and sale consideration is 250. So yes, what will be the situation? Next example is 100. Fair market value is 200 and sold for 150. The third scenario is it is acquired for 100. The fair market value is 50 and it is sold for 150. And the last scenario will be it is acquired for 100. The fair market value is 200 and it is sold for rupees 50. Yes. So what will be the situation in all these four cases? Yes, tell me. Yes, students, come on. First situation, what will be your cost of acquisition and then capital gain? Yes, students, faster. First situation, what will be your capital gain? Yes, my dear students, faster. Students, yes. I'm not getting any answers. What will be the answer? Okay, let me tell you. So in this case, what you will do is first you will consider the lower of FMV and the sale consideration. So 200 or 250, what is lower? Of course, 200 is lower. So first is, this is going to be lower of this is 200. Then the higher of this is 200. Cost of acquisition in this. So obviously my cost of acquisition here is 200. My capital gain will be rupees 50. Right? In scenario 2, what is lower? See, this is very simple. This is 150. Then the higher of this is 150. So 150 will be my cost. My capital gain will be nil. 0. Here, what is lower? 50. Here, what is higher? 100. So 100 will be my cost of acquisition and this shall be 50. Correct? Here in this scenario, what is lower? 50. What is higher? 100. So in this situation, in the situation 4, there is a long-term capital loss of rupees 50. So this is 100. This is long-term capital loss. Yes or no, students? Is it clear? Okay, so just write it last point over here. No indexation and foreign exchange fluctuation benefit. Okay, you will not get any indexation or foreign exchange fluctuation benefit. Then the last section, which is section 112, long-term capital gain. Now we have seen 112A. Now we are moving towards 112. Okay. Now in the case of 112, which is there, which are the assets? All the other assets are now covered in 112. Okay, all the other assets are covered under 112. So for 112, what are the tax rates? There are different tax rates. So first is for the resident, individual or HUF. So here you can write the taxpayer, here you can write the asset, and here you can write the LTCG tax rate. For the resident, individual or HUF, this will be 20%. This will be the long-term capital gain on any other asset is going to be 20% with indexation or 10% without indexation. So basically for the resident individual, you can write it over here, any other asset. Here you can write other than section 112A. This is 20% with indexation or 10% without indexation, whichever is beneficial to taxpayer. Fine. So 10% without indexation benefit or 20% with indexation benefit. Clear? So in this case, what is the tax rate? It is 20%. It is 20%. Basically, this tax rate is 20%. Sorry, here you should not write this. Sorry, this is only applicable for. Sorry, just remove this. Just write 20% with indexation. In case of any other asset. But where the asset is a listed security or a zero coupon bond, where the asset is a listed security, listed securities or other than unit, where the asset is a listed security or zero coupon bond, not a unit, then in that particular case, the 10% without the indexation. Then it shall be 10% without indexation. So it can be 10% without indexation or 20% with indexation, whichever is beneficial. Whichever is beneficial to the taxpayer. Or lower or whatever. You can just write lower or beneficial. Or you can just say lower. Fine. So in case the capital gain is arising on listed securities, not a unit, but only listed security. But you will say, ma'am, listed securities is covered under 112A also. 112A when you are paying the STT. If you're not, let's say, paying the STT and you're not even covered by that notification of central government, and then there is listed securities which are transferred. So then in that case, you will be coming to 112. Or in case of zero coupon bond, then you can cover either 20% with indexation, 10% without indexation. Now for the individual or HUF who is a resident, you can utilize the unutilized or unexhausted basic exemption limit. So unexhausted basic exemption limit can be utilized. So just write down unutilized basic exemption limit can be utilized. Fine. Now this is for the resident individual or HUF. Then in case of a domestic company, what is a domestic company? Domestic company means an Indian company or a foreign company which has made the arrangements for declaration of dividend in India. So for a domestic company, it is flat 20%. Any other asset, this is 20% with indexation. 20% with indexation. Fine. 20% with indexation. In case of, again, the listed securities or the zero coupon bond, then again you will have the option of taking 10% with indexation or 20% without indexation, whichever is lower. So for any other asset, it is directly 20% with indexation. For listed securities or zero coupon bond, it is 20%. Okay, so just I'm pasting it over here. Okay, fine. Now next one is any other resident which is there, which could be partnership firm, AOP, BOI, any other person. For them also it is the same. So for them also this is going to be 20%. Domestic company or a resident, AOP, BOI or a partnership firm. So for them also this is going to remain same. Now in case of a non-resident, or a foreign company, in case of a non-resident or a foreign company, then in that particular case, it shall be, if it is any other asset, then of course it is 20% with indexation. If it is any other asset, it is 20% with indexation. If it is unlisted shares or shares of the closely held company. So if it is unlisted shares or shares of closely held company, this is going to be 10% without indexation or foreign exchange fluctuation benefit. So no first or second proviso to 48. And again, if it is listed securities or zero coupon bonds, then it is 10% without indexation or 20% with indexation, whichever is lower. Fine. Yes, so I'm just copying this again. Okay. Whichever is lower. Fine. So this is my 112. Again, under 112, you cannot claim the Chapter 6A deduction. You cannot claim the Chapter 6A deduction. Okay. So you can write here, no Chapter 6A deduction. Yes, any doubt, any questions? Is it clear? So under Chapter 6A, you cannot claim any deduction. Now, last very important point in terms of the tax rates. So, if you remember now, we had discussed the tax rates which are under your 115 BAC or under normal provisions, right? In all of these cases, if you remember, the maximum surcharge on the LTCG, which is under 112A, or STCG under 111A, will be 15% even if the capital gain exceeds rupees 2 crores or 5 crores. Remember that? So you have to write it over here. Just write it down in the tax rates, because this is the error which most of the students make. So just write over here the maximum surcharge on LTCG or LTCG under 112A, not under 112, or STCG under section 111A is going to be 15%. Even if capital gain exceeds rupees 2 crores or rupees 5 crores. So if you remember, I told you that total income excluding the capital gain, only if it increases 2 crores, only then the higher surcharge will be applicable. But if total income including the capital gain is more than 2 crores, then the highest surcharge will be 15%. Clear? Yes or no? Fine. Now, the last one which is remaining is the exemptions under section 54 series. Rest, other than that, we are done with the entire capital gain. There's one small section, section 51, but that I will take into consideration along with the income from other sources. So that's a very, very small section which is applicable, which is advance money received. Okay. So basically, what we have to do now is the 54 series. Now, as I told you, the 54 series which is there, that will give you the exemptions from the capital gain if you invest the amount into a proper specified asset. So we are going to talk about that. So let's start with the exemption under 54. Just write down the last part of your capital gain. Exemption under section 54. Now, first is section 54 itself. Or let me write it like this, section 54. Now, first of all, who is the eligible assessee? Under section 54, it is the individual or the HUF. Okay, under section 54, it is the individual or HUF. Under section 54, under section 54B, it is again individual or HUF. Then we have under section 54D, here it is any assessee. 54D, it is any assessee. Then we have 54EC. Under 54EC also, we have any assessee. Under 54F, it is again individual or HUF. Under 54F, we have individual or HUF. Then we have section 54G. Again, it is any assessee. 54G, 54GA, both we have any assessee. Okay. And that's it. Fine. So basically, we have these all sections that we have to cover. Now, first I'm starting with 54. Now, 54, what is the asset that should have been transferred? For 54, there should be a transfer of residential house property, a long-term capital asset, which is a residential house property. So, transferred asset, or you can write here, asset to be transferred. Long-term capital asset being residential house property. It should be a residential house property, the income of which is chargeable under IFHB. Are we getting that? Whereas, in this case, what you should purchase is, what should be an asset which is purchased? So, here the specified asset which is to be purchased is again a residential house property. So, you're purchasing one house and selling one house. So, that is what 54 is all about. So you're selling the house, and in lieu of that house, you're purchasing another house. So it should be a long-term capital asset being the residential house, the income of which is chargeable under IFHB, and the assessee has to purchase the another residential house. Then only he will get the 54 exemption. Now, what is the time limit for purchase? The time limit is within 1 year before or 2 years after the transfer. So purchase within 1 year before or 2 years after the transfer. Second, within 3 years, construct within 3 years of transfer. Fine. So 1 year before or 2 years later, you have to purchase, or within the 3 years, you have to construct. Then you will get the capital gain exemption. Now, what will be the capital gain exemption? So just write down, exemption will be, so where the capital gain exceeds rupees 2 crores, where the capital gain exceeds rupees 2 crores, then you can purchase only one house property. But where the capital gain does not exceed rupees 2 crore, then you can, at the option, purchase 2 residential house property. But this option of purchasing the 2 house property or constructing the 2 house property is only allowed once in a lifetime. Again, you will not be given this option anytime during your life. So let's say, for example, in this year, I have capital gain lesser than 2 crores and I purchased 2 residential house property. Then in the subsequent year, I will never be entitled to avail the benefit in respect of 2 houses, even if my capital gain will be lesser than 2 crores. Are we getting that? So just write it over here. Specified asset to be purchased, I have written here, residential house property. If capital gain lesser than rupees 2 crore, then 2 house property at option once in lifetime. The option of assessee once in lifetime. And if my capital gain exceeds rupees 2 crores, then 1 house property. 1 residential house property. Fine. Yes. Now, what will be the capital gain which will be exempt? So, the capital gain exempt over here will be the long-term capital gain which you have invested, or the cost of the asset to the extent of the long-term capital gain, that will be exempt. So, entire long-term capital gain or the amount that you have invested. So let's say if you have long-term capital gain of 2 crores and you have invested 3 crores, then 2 crores will be exempt. If you have long-term capital gain of 2 crores and you have invested just 1 CR, then only 1 CR will be exempt. But the maximum exemption that is available under section 54 is going to be rupees 10 CR. The maximum exemption which is going to be there is going to be 10 CR. So just write it over here. This is the Amendment of Finance Act 2023. The long-term capital gain will be exempt, or the cost of house, whichever is lower, but this shall be restricted to, or you can write maximum exemption rupees 10 crore. Rupees 10 crores. So this is my Finance Act 2023 amendment. Fine. So the maximum exemption can be rupees 10 crore. Let's say, for example, if I have LTCG of 7 CR and I have a new house of 12 CR, I can only claim exemption of 7 CR because my LTCG is lower. But let's say, for example, my LTCG is 12 crore. Then the maximum exemption I can claim, and let's say I've invested entire 12 crore in the new house, I will only claim 10 crore. Okay. And in case the assessee is unable to buy the house before the due date of filing the return of income, then he has to deposit the amount in the capital gain account scheme. In the capital gain account scheme. Now just write down what is the consequences. Consequences if new asset is transferred before 3 years. So the new asset should not be transferred within 3 years from the date of acquisition. But if it is transferred, then the cost of the asset, will be reduced by the capital gains exempted earlier. And that shall be taxable as short-term capital gain. So let's say, for example, I had long-term capital gain of 2 crores. And I had purchased the house for 3 crores. Now, from the cost of acquisition, the long-term capital gain exempted earlier will be reduced. So let's say, for example, let's take an example over here. Let's say I had the LTCG of 2.05 crore. Cost of new residential house property is, let's say, rupees 3 crores. Right? Now, if this is sold within, let's say, 2 years, so let's say for rupees 5 crore, then the capital gain will be FVC 5 crore. Cost of acquisition will be 3 crore minus 2.05 crore exempted early. So only 95 lakh will be my cost. So there will be, since it is less than 2 years, 24 months, so my short-term capital gain will happen, which will be 4.05 crore. Clear? Yes. So this is how 54 has to be computed. So if it is consequences, if sold before the 3 years, then cost of acquisition will be reduced by long-term capital gain exempted earlier. Yes or no, students? Any questions? Any doubt? Okay. So we'll stop here. In the next class, what we will do is we will continue the 54 series because one major one we have already done that is 54. Rest of them are very small. So in the next class, we'll finish it off this and then we will start the income from other sources. Fine. So we'll stop here for today. Thank you so much, but please keep revising. Yes.